Hey, what is up, everyone? Welcome to this video. We hit a milestone here in personal value, as you can see here. So what I'm going to be doing in the next video is I'm actually going to be breaking down my full portfolio. So the full 2M portfolio here, and I am pumped up about it. So what I'm going to do in this video, though, it's a continuation of my last two videos, which was what I did with a specific account. That specific account is our pension trust account, which is our retirement account. So I showed you in the last two videos where I would put money, and there is 20% left out of that allocation. So what am I doing with the retirement allocation? Well, the first thing that I'm doing is I have put 60% into the US stock market through something called VTI, which is a ETF that basically owns the entire stock market, made up of thousands of stocks. And if you buy VTI through Robinhood, Webull, whatever brokerage account you have, you're going to basically own the US stock market. The next thing, in my last video, I talked about buying 20% of the international. And the way I did that was VXUS. This is the international minus, which is XUS. So that way I have international exposure. So if you're watching this video, this is probably going to be one of the most boring videos I put out, because this last percentage is going to be something that probably is going to be your lowest return. And that's 20%, right? The last 20% in bonds. And it's the total bond market, which is BND. Right, BND. So these are all Vanguard exchange traded funds, ETFs. And what I'm trying to do with this retirement account is I want to diversify, right? So US stock market has been doing great, definitely since its lows. And then international stock market, 20%. So that's the international companies. We're talking about companies like Nestle or Toyota, so all over the world, and then the bond market. So this allows you to buy different kinds of bonds, again, through an ETF. So what that is BND, which is Vanguard's total bond market ETF. We can see here $126,000 worth of that. And what you're going to see is that the bond market pretty much moves inverse to the stock market. So today, for example, we have kind of a negative day, and you can see that my US stocks, VTI, is down by 2,000, my international is down by 1,000, and my bonds are up by 300. A bond is basically a promise from a government, from a corporation, to pay you back the amount you lend it plus interest. And that's what a bond is, basically like a promise to pay back. There's a lot of different kinds of bonds, and by owning the total bond market, you're pretty much going to own all of the bond market. It computes to 60% of US government bonds, which are pretty much the safest, then AAA, which are the next safest, and then AA, and then A, and then BAA. So in these percentages, 60, 3, 3, 12, 19. Now, the lower the quality of bond means that maybe they're going to default, right? It has a higher probability of not paying you back. And what does that do? Well, it also gives you the highest return if they do pay you back, because the higher the risk, the higher the return, and that's how bonds work as well. But this is a good mix of bonds with mostly the US bonds, because what we're trying to do with this allocation, with putting 20% in the bonds, is we're kind of going after the less risk potential in our portfolio. So US stocks, pretty risky. International stocks, pretty risky. I have a high percentage of stocks to bonds with this portfolio being 80% stocks, because 60% of that 60% is US and 20% is international, but there's also 20% in bonds. So that is labeled as a very aggressive portfolio because it's high in the stock percentages. If you are older and you want to take the money out in the next 10, maybe years, that might not be a good horizon for you. You have to decide what's best for you based on your horizon of taking money out. I'm not going to be at an age where I can take out the retirement funds for at least 30 years, and therefore I have an ability to go with a little bit more volatility, meaning 80% in overall stocks, 20% in bonds. Now here's the thing, you might think, you know what, let me just go all stocks. I'm young, you guys are mostly between 25 and 35. If you're watching this channel, give me a thumbs up. If that's you, give me a like in the video so I can see that. but that's mostly what you are. So you are probably like, you know what, I can deal with risk. I'm going to just go for it, 100% stocks. And I can't do that because I have a retirement fund. It includes a couple other people, so I have to be fair to them. And I have to act as a fiduciary, meaning I'm acting in the best interest of everyone. Something to also keep into account is, yeah, sure, it's good to diversify risks, right? So bonds often go up when stocks go down, and that's because people are going to flock more towards safer investments if the stock market is going down, and people are going to kind of take more risk in the stock market if the stock market keeps going up, right? So that's kind of the supply and demand that happens over there. This is an overall performance. You can check it out. 3 years, around 5%, 4%, 10%. This is the average per year, average annual return since 2007. It's around 4.5%. You can see in the last year, though, pretty good, right? 9% in the last year, which is really high for bonds. This is the hypothetical growth of $10,000, starting from 2010, and it gets to $14,000. And if you compare that to the U.S. stock market, it doesn't look so good. This is the U.S. stock market, and you would be at $36,000 compared to $14,000. So you're thinking, maybe I'll just go full in stocks, and that is up to you. One thing to keep in mind, as Ray Dalio has said, just because one asset class has been performing great, even since inception or 100 years, doesn't mean that's going to continue to be the top performer. That's why you need a diverse portfolio. If you're watching this video, maybe you actually want to learn how to talk about this stuff, and it's actually really confusing. So let me kind of get into it. Most bonds pay a fixed interest rate. Okay, so that means most bonds say, hey, I'll pay you 1%, let's say, and that actually becomes more attractive on the secondary market. I'll talk about that in a second, if interest rates fall. So if interest rates fall, then there's more demand for those bonds, which drives up the price of the bond. Because think about it, if your bond's willing to pay 1% and interest rates are only going to pay you 0.5%, then there's more demand for your 1% bond, right? But if the bank or interest rates are paying 2% and you have a 1% bond, that's not going to make sense, right? So that would lower demand. So if interest rates rise, investors no longer prefer the lower fixed interest rate paid by a bond, resulting in a decline of the price of the bond. So then there's this other thing called yields, right? How much does the bond give you in yield or interest? So during the COVID-19 pandemic, investors flee to the relative safety of bonds, especially government U.S. treasuries, which resulted in yields plummeting into all-time lows. And that's because there's still this supply and demand mechanism, right? So if people are running to bonds, that actually causes the yield of the bonds to go down, the interest on those bonds to go down, because people are buying, and those bonds can get away with not giving as much interest. So unlike the stock market, right, where more people buy a stock and that stock goes up, this is actually the opposite in terms of your yield. The more people that buy a bond, your yields can be going down. You can kind of think of yields as a sale, right? So if you're buying a product and it's on sale, then you want to buy that product because it gives you value. But if more and more people are buying that product for that sale price, maybe eventually that sales discount is going to shrink smaller and smaller because there's demand for it. The great thing about buying bond ETFs that hold all of these bonds is that if the value of those bonds goes up, your portfolio goes up. You don't need to actually buy all the bonds, wait for them to mature, some of them 5 years, 10 years down the line for you to get any kind of return. How does the secondary market work? I know we're kind of getting into the nitty-gritty of this, but I thought we might as well do it if you're watching a video on bonds, kind of the most boring investment vehicle that you're probably looking at. So what is the secondary market? So say you buy a US government bond, right? And you buy 60 of them. You buy 3 AAA bonds, you buy 3 more AA, you buy 12 A's, you buy 19 BAA bonds, right? What's going to happen is that, sure, you can wait for those bonds to mature and give you the yield, but there's also this thing called the secondary market, which means that you can sell those bonds to other investors. And those bonds go up in value if the interest rate goes down, right? So these government bonds that you've that you hold that have a high interest rate, well, guess what? People are going to be more likely to buy those from you than the current interest rate because interest rates are now lower, right? So the value of your bonds goes up. So in this scenario, your overall portfolio would go up if those interest rates go down. When we look at this 1 year mark and see like the highest growth since the last 10 years, then it makes sense because the federal funds rate is near zero now. And so our bonds that were being held in this account are valued at a higher rate now. So the secondary market allowed us to capture some of that value immediately. So that is my 3-fund portfolio that makes up the entire retirement fund. So that's $636,000 worth of value, and we split it up 20% to bonds, which I just showed, 20% to Vanguard Total International Stock Market, and then 60% to VTI, the Total Stock Market Index. So what I'm going to see is over time, these percentages are going to get out of whack, right? They're not going to stay the same. If the stock market does good, then these are going to start going up. If the bonds do good, this is going to go up. And if it becomes too disproportionate, then what I'm going to do is I'm going to rebalance. And I'm going to actually rebalance just once a year. Just going to do this automatically when we want to fund our retirement account. And I'm just going to rebalance by putting in amounts into each of these 3 different ETFs so we get back to the same ratio of 20, 20, and 60. I automatically have dividends being reinvested automatically. Overall, what's been performing the best since I created this account about a month ago? Well, that would be VTI Total Stocks, and then VXUS, and then third would be bonds. As you can see, the gain loss right here. This can easily change at any moment. If coronavirus has a huge second wave that leads to massive closings, guess what's going to happen? This is going to outpace probably everything. If you're still watching, congrats to you because you just watched a video on something kind of boring, which are bonds. It took me a long time to really understand how it works with interest rates and the secondary markets, and it's pretty confusing. I think it's important to have a diverse portfolio no matter what, even if you're young, because guess what? It could very well be that bonds outpace stocks for the next 100 years. It's really hard to tell, and thinking historical data will mean what the future looks like, that's kind of unrealistic. We can learn from historical data, we can see overall what happens in different environments, but it's also important to realize that we don't know everything. So that's it. Please subscribe, please like this video if you did. Sorry I haven't been making these as much, but my next video will be on a full breakdown of this portfolio. I'm going to show you the percentages, and I'm going to make it a little bit more organized so we can clearly see what's going on. That's it. Thanks so much, and I'll talk to you soon.